We're at the point now where it really matters. So debt doesn't matter. Debt is good now. Bitcoin reminds me of the World Economic Forum, right? Klaus Schwab, eventually, you are going to own nothing and be happy.
There's going to be more debt, more spending, more QE, lower interest rates, and a whole lot of tailwinds for gold and more explosive tailwinds for silver.
The US economy is driven off of debt. These royalties, they do well when gold goes up, and they do even better on a relative basis when gold goes down. We've got some big winners already this year.
All right, Garrett Goggin. I actually called you David at one point in our communication because I mistook you for David Goggins. So please take that as a compliment. And I thank you so much for being here. I'm looking forward to talking about gold and silver.
Yeah, it's no problem. He's my brother from another mother.
I can see the
I
similarities
like him.
there.
I've been reading him for a while too.
I want to start with silver in particular, though, because of many things. Obviously, silver incredibly interesting when it's running. It's running like nobody else. But you tweeted something recently saying that silver is getting up, or gearing up for a big move higher. But it wouldn't be the first time I've seen that on Twitter over the last few years. So why do you think now is the time for silver?
I follow the commitment of traders every week, and to be honest with you, I know there's guys that specialize in it. They write the commitment of traders doing this basically on a daily basis. I don't see much going on a daily basis. However, at times it reaches extremes where it becomes significantly, statistically significant. And one of the things that popped out to me was silver net other holders. It's not commercials, it's not managed money, it's the other is about 15% net long silver. This is the deepest it's been in since 2008, basically, when silver took off up to, it looks like $40 an ounce. So I see this as being statistically significant, and I figured I'd mention it. And these commitment traders, they come out on a weekly basis, and sometimes they're early, and it takes weeks or months for the trend to turn, but it often gets you on the right side of the trend.
What do you think the time frame for this to play out is now, though? Is it weeks or months?
It's tough to say, ever since, Trump won the election, gold has sold off, silver has sold off due to people thinking Trump's going to get the deficit under control. And I don't think it's going to be long before the public is going to realize and see that it's going to be the same old supply side economics with the trickle down effect that really never works. And the spending is going to continue. The deficit's going to continue higher. So that economic realization, I believe, will be, happening. That's going to set the next leg higher for gold and silver. One other thing regarding silver, you got to be careful regarding silver, right? Because silver mining margins are lower than gold mining margins. The number of, profitable silver mines out there, I can basically count on one hand. I'm friends with Peter McGaw, the world famous silver geologist that founded Mag's Juanicipio in its first drill hole. And he shared with me a study by, it was called Archie's Rule by Archie Bell, who was head of exploration at Noranda. They needed a simple back of the envelope calculation for geologists to follow to figure out whether a deposit is worth pursuing or not. And what they figured out is that you need to figure out what your operating costs are, which is relatively standard across jurisdiction. You look at any operating mine in Mexico, it's about $250 a ton. You need to have your revenue be 2 times your operating costs for it to be a worthwhile project. Now, that's all contingent upon grade. Grade is the only thing that moves the needle on revenue and profits because costs are relatively fixed on a per tonnage basis. So in order to get to $500 a ton, which would be 2x the operating costs, you need grades of 400 grams a ton per silver equivalent or higher, 500 grams per silver equivalent. Not many mines fit that profile. Mag, Juanicipio fits it. Silvercrest, La Chispis fits it. And you can look at Silvercrest, Las Chispas. They generated so many profits. They paid back $40 million of debt in less than a year. They put $100 million of cash in their bank account, and they got purchased by Core Mining because they're so profitable. Versus a lot of other small miners that chug along and break even. They don't make any money. Management and bankers get paid while shareholders, their values diluted away. And then there's a lot of smaller silver names that are heavily promoted as well on Twitter. You got to be careful. Just follow the high grade ones. That's all I got to say. And then silver lags gold, and silver trades. If you run a regression on gold to silver, silver trades at a discount to gold like 95, 96% of the time. But that remaining 4% of the time, it spikes higher, like a lot. Like it'll go from 30 to 40 to 50 to 60, or I don't know, maybe even 100. But these spikes are short-lived. They only last like a week or two. Like the last one we saw was the Reddit, the silver squeeze. That is First Majestic went up like 30% in a day. It lasted like a week and it was over. I prefer investing in miners that can add value on an accretive basis on a daily basis. You know what I mean? Versus waiting around for overly leveraged, unprofitable, mining companies to get that once in a lifetime short spike higher in order to profit. I prefer the miners that can do it on a daily basis.
Leveraged and unprofitable. I feel so seen right now. I cannot even explain it. But we'll get to talking about these companies though later. So we'll talk about them later. Yes, let's do it later. What I'm thinking about now though is how high? You say 30, 40, 50. How high do you think silver can get on this move here?
You know, I'm a chartered financial analyst from Boston, MBA from Babson College, ranked by Wall Street Journal, #2 in the nation. I'm really good at digging through the financials, the MD&As and financials in order to, figure out the true economics of these companies. I look for value creators that can grow economics on a per share basis. And to be honest with you, there aren't many out there because mining is extremely tough business. You need good management aligned with a high grade resource in order to do that. I don't necessarily like making gold and silver predictions, but because I'm good at the fundamentals and I like sticking to that. But I'm a CMT as well, so I read the lines. I involve a little bit of trend analysis, trend following, in my analysis to find the miners that are moving well, and then just quite simply looking at longer term charts of gold and silver. Silver and gold have been in a cup and a handle. They've been for a decade, and they're starting to break out higher. The first breakout was 30. The next breakout is going to be, God knows, 50, 100 on silver. But again, silver, moves quickly and then it falls back to, reality. Although, this time could be different because, the US government's $37 trillion in debt. It's truly, the limits of Keynesianism, and Keynes said, in the long term, we're all dead. So keep on piling on the debt and it doesn't matter. Well, we're at the point now where it really matters. And for gold, I look at sentiment measures versus gold. I looked at GLD shares outstanding. So when someone buys a share of GLD, the shares outstanding go up. When they sell it, it goes down, unlike shares of stock, because it's an ETF. GLD is linked to 1/10 of an ounce of gold, and that's what they hold. Whenever gold spikes higher and makes a high, the shares outstanding spikes higher as well because investors rush into it. It creates a spike higher and then it fades off, and that ends up being the peak. GLD shares outstanding is it's about 60% of what it was at the high in 2011. Like we're not there yet. The retail investor is not there yet. I sell, a retail oriented product with a lot of institutional following, but investors don't care. I like going to Germany. I like going to Switzerland because, they get it. They live through it through countries and currencies. The average US citizen, you ask them what a dollar's worth. They say, what do you mean what's a dollar's worth? It's worth $1. Are you stupid? It's like, no, man. It's worth, 98 cents of a euro. It's worth $1.30 Canadian dollars. Europeans get it. But the US investor's not on board yet. And one other thing that might blow your mind is if you look at the market cap of the SPY ETF versus the GLD ETF, the GLD ETF had more assets under management at the peak in 2011 than the SPY ETF. The SPY is like one of the most widely held ETFs that tracks the S&P 500, and right now the GLD trades at 10% of the value of the SPY ETF. So looking back upon that equal value, even if the S&P crashes here, you're looking at a 5x upside for gold here. In order to put it in perspective. And a lot of people, you mentioned gold, everyone's like, oh, $2,700, oh, it's so expensive. It's like, it's not even close because you look at food prices in the United States, I'm paying 2, 3 times the amount that I was 3 years ago. They say inflation has gone low, but you know what? Inflation never goes negative. It always keeps on chugging higher. And we're seeing that in the loss of purchasing power because of the amount of debt that's being spent. And it's continuing. And we're at the point where it's going to continue at an accelerated rate because a dollar's worth of debt used to produce $2 worth of GDP. As a debt increase, it produced a dollar's worth of GDP. And now a dollar's worth of debt only produces 83 cents of GDP. And the amount of debt needed to generate product GDP growth is going to go 2x, 3x, 5x. We are in the long run right here.
What's also interesting to me, debt to GDP obviously matters. What's also been interesting to me is to see what percentage of the country's GDP goes toward interest alone. Because there are countries that have a worse debt to GDP ratio than the US. But if you look at the interest rate payment on the national debt, that is a disproportionate amount of the country's GDP. I think the US is in one of the worst situations possible. I don't have and I should have had the exact numbers in front of me, but that's also another interesting point.
Yeah, there's no doubt. I follow that closely. I don't know. I think it's between 5% of GDP that they're paying in interest right now. And then this gets interesting because if you look at government spending as a percentage of GDP, it's like 40 to 50% of US GDP is government spending. The government drives the economy. If the government stopped spending and cut their budget, the US economy would collapse in a deflationary house of cards. So the government has to keep spending. If you look at the most expensive real estate markets in the United States, it's all around DC. There's hundreds of thousands of people making $500,000 a year not doing anything. It's a bubble, but it's going to continue. The U.S., Trump spent $8 trillion last time he was president. Biden also spent $8 trillion when he was president. There's proposals that they're going to trim the spending, but the spending's got to continue. Do you know Stephanie Kelton, who wrote the book The Modern Monetary Myth, the whole MMT, Modern Monetary Theory?
Yep.
Yeah, she's being grasped by both parties because what she says is you need to look at both sides of the ledger. The amount of debt that you spend produces economic growth. So, and the US can always print more money to cover the debt. So debt doesn't matter. Debt is good now. She had another proposal that I saw on Twitter. Some guy proposed cutting rates to zero so the US wouldn't have to pay any interest on the debt, and the Fed monetizing all the debt. This is what we're getting into right now, and I see it coming because Scott Bessent, the new Treasury Secretary, he is proposing a shadow Fed chairperson or shadow Fed member. So the Treasury and the Fed are going to become more aligned. The Fed's going to lose their true independent status. The Fed is going to have to abide by the political rules. And that, according to Scott Bessent, he follows Shinzo Abe's failed 3 arrows strategy in Japan. He thinks it was great. Basically, cutting rates to zero, spending tons of money, monetizing the debt. It's coming. There's smoke everywhere.
Garrett, I thought MMT was magic money tree.
It is. That's what I call it. Yeah. Magic money tree. But you see, it allows politicians to spend without limit because it is pegged off economic growth. So politicians from both parties embrace this, right? Because they can just keep spending because it's all good. It's good for economic growth.
Could gold be part of the solution, though? I mean, I saw you retweeted something from Judy Shelton. There's a proposal for a 50-year treasury bond convertible into gold, and that would be issued at the initiative of President Trump, and it said that it would be issued in the summer of 2026. Could that be part of the solution?
Yeah, let me tell you three things that I see happening based off the signals that I've been following. Judy Shelton's great. You know, she's starting to get a lot of publicity. Trump is a big fan of hers. Trump tried to get her on the Fed Board of Governors back last time he was president, and he's going to try to do it again. Judy Shelton proposed a 50-year U.S. Treasury bond backed by gold, and you know, I think it's a great idea because Scott Bessent and all the political leaders know we're at the end times of Keynesianism. They know that they have to restore confidence in the US dollar. So, one of the ways they can do that is by bringing gold slowly back into the financial system. That 50-year treasury, if they did that, I think it would be a cataclysmic failure because the US would owe so much money that they would have to keep printing more in order to finance that debt. The one other thing that I've seen happening across the European community is GDP pegged to gold, right? Holding 4% of your GDP in gold. And if you look across the European community, the majority of them, Germany's at 8%, Poland's at 6%, Holland's at 4%. They're all at about 4%. And the Holland central bank governor and the Italian central bank governor have all said gold's a monetary asset. We hope to peg GDP, our gold reserves to GDP. The US is at 2% of GDP. They hold 262 million ounces. They would have to double their gold reserves. China's been buying tons and tons, like 260 tons over the past year. They only hold 1% of their GDP in gold. But I honestly, I could see this happening. I could see this being implemented as the politicians get together and say, listen, we're going to back GDP to gold. Now, at first blush, you're like, okay, great. And it is good. Gold's being recognized as a monetary asset for the first time in 50 years again. And, you know, they're pegging the GDP to gold, but that leaves out debt, right? If you peg GDP to gold, this allows politicians to keep spending billions and billions and trillions of dollars of debt to produce growth. And it leaves out gold as a monetary standard. It's not the true peg to the monetary standard because it omits the debt. So I see this happening as a first step to restore confidence in the US dollar. They're going to say, hey, we're going to peg GDP to gold. And it's going to be a cataclysmic failure because our debt's going to go from 37 trill to 40 trill to 50 trill to 60 trill, and it's game over. And then at that point, they're going to have to bring gold back into the financial system as a true monetary asset to totally restore confidence, not some political shell game. And, you know, where we're at, I see it happening quickly. And then the third thing that is going to bring gold back to the forefront of a monetary asset is the Bitcoin reserve, right? You know, I bought Bitcoin at $10 back in, I don't know, 2013, and I sold it at $200. You know, I'm a genius. You know, I made a ton of money. But I guess I should have held on to it. And Bitcoin and gold share common characteristics that both store value, you know, protect against loss of purchasing power. But it reminds me of Bitcoin reminds me of the World Economic Forum, right? Klaus Schwab. You know, eventually, you know, you are going to own nothing and be happy, right? Where the politicians and big business are going to own all the assets. And you know, the digital asset Bitcoin reminds me of that. It's, you know, you will own, you know, nothing. Me, I prefer to own physical assets like big business and like the politicians. Every Bitcoin transaction you can trace through the IP to your cell phone, to your laptop, to your computer. Once you buy gold, it's out of the monetary system. And Bitcoin, you got to bring it back in. You're going through a broker, you're going through a bank, you're going through a financial intermediary. You know, the government and the IRS are watching every single transaction that occurs. When you buy gold, it's physical. You're taking it straight out of the equation, and often to never return back to the you know, the financial world.
Hmm. Well, talking about physical, there's something else that I saw you tweeted out, which was something about the Sprott Physical Gold ETF that is currently selling at a 2.2% discount to fair value. Um, that is typically being a good indicator of sentiment. How are you using it, and why do you think that suggests a move higher?
Yeah, it's the same thing. It's a physical gold ETF. It trades at a premium or discount to net asset value, and it's trading at a 2.4% discount to net asset value. And in previous peaks in 2011, it trades at a premium, and we're nowhere near that. But these signals right here, they just show you, they give you the confidence to stay on course and to stay long. I'm not a trader, I'm an investor, so I don't try to trade the wiggles. To trade the wiggles, you got to ignore the news and you're just trading price. You know what I mean? In order to do that successfully. I measure value on a per share basis, and stocks follow that earnings per share or free cash flow per share. So I prefer to find the undervalued miners and wait for gold to rise so the miner can recognize full value. Basically, these sentiment measures, they take a decent amount of time to play out. Like today, we're seeing gold down, I don't know, what is it, 60, it's down like $40 today. And I just posted these things yesterday, so I look like an idiot. But we're not talking about today, we're not talking about next week. We're talking over the next months where we're going to see the rise in the gold price.
Hmm. Well, so if I understand it correctly so far, what we've been talking about, Garrett, is that there's going to be more debt, more spending, more QE, lower interest rates, and a whole lot of tailwinds for gold and more explosive tailwinds for silver. Am I getting it correctly so far?
Yeah, no doubt. And then, one of the things regarding Trump and the policies that he is proposing, it's Reaganomics. It's trickle-down economics that never worked. It created a larger gap between the rich and the poor because the rich own all the assets and the poor suffer from inflation. It's straight up Reaganomics. And when Reagan was president, the deficit was $2 trillion and it worked fine because it didn't matter. Now we're at $37 trillion. This is going to be disastrous. And Trump is a businessman. And one of the great quotes from Trump is I'm having trouble finding it, but Trump loves debt. He said, I'm the king of debt. I love debt. If I run into trouble, I just go back and I tell the bank I can't pay and I only pay 50%. And, it reminds me of that old expression, if you owe the bank 10 mil, you're in trouble. If you owe the bank 100 mil, the bank's in trouble, and if you're the president of the country who loves debt and the country's in $37 trillion of debt, its people are in a lot of trouble. Trump built his real estate empire with debt, and he failed a couple times going through bankruptcies. And he's going to run the country the exact same way. It's all, cutting restrictions on big businesses, adding tariffs to foreign imports. He believes as long as big business does well, the whole economy and everyone will benefit. But trickle down economics has never worked, and he's going to keep spending like he's never spent before.
All right, but humor me here for a second, Garrett, because I'm thinking, what could I be? I'm in complete agreement with you. I don't see us spending or the U.S. spending less money, or they're having less debt, or going into deflation or anything like that. But what would it make? What would it take for this not to happen? What are maybe some challenges or risks to this narrative that I might be missing?
Let's go through a thought experiment. So let's say, the Department of Government Efficiency comes in with Elon Musk and Vivek, and they're able to cut trillions from the budget. They're able to, so the government spending is going to go down. The amount of debt's going to go down. The US economy is driven off of debt. It is a debt inflated bubble. If they were ever successful in cutting trillions from the debt, our economy would crash in like I said before, a deflationary house of cards. The Fed would have to step in order to, provide the stimulus and to purchase all the debt in order to push the economy further. So what people look at as a good thing, is going to turn out to be an extremely bad thing.
Hmm. So essentially, you're saying there's literally no way that the U.S. spends less money, less debt, less inflation.
I don't see it, You look at the public debt over the past since 1970, the past 50 years, it's gone up every year. Like, yeah, as a chart guy, you look at it, every single year it's gone up. Every single quarter it's gone up. It's not going to stop.
Hmm. But then you talk about, and there's something else you've talked about on Twitter. You talk about 4% of GDP being pegged to gold. Is that the way out?
I see it as the initial step to reintroduce gold to the monetary system, and it's going to wake a lot of people up. People are going to go, "Oh, gold. All right, it actually is a monetary asset." All the Federal Reserve and all the central bankers, like if you were at a bar at one of your gold conferences and you had a couple beers with them, they would all admit to you that gold, is the bedrock of every monetary system. But in public, they're never going to say that. Why has U.S. gold been holding 262 million ounces on the balance sheet for 50 years without selling any? Because they know. And then, being able to peg it, the GDP to gold, even though it's not going to work because it doesn't include debt or money, is going to open up people's eyes. I just like this whole Trump administration. I see this as his great awakening, right? Great awakening in America. We got away from our roots. He appointed Robert Kennedy, right, as head of FDA because have you ever seen that website WTF happened in 1971? Do you
Yeah.
know what I'm talking about? Yeah, you know what happened in 1971? We got off the gold standard, and then what happened? It all became about big business and politicians shoving money in their pocket. They bastardized our food system in order to, maximize revenue. The FDA believes a bowl of Fruit Loops is better for your kids than, an egg or two. It's absolutely crazy. So they got Robert F. Kennedy in to restore our food to where it was back in the 1970s. If you look at pictures of people on the beach in the 70s and 80s, everyone was skinny and healthy. And now every 50, 60% of the American population is obese. Why? Because it's good for business. They're consuming all the food and then they get sick and they need more and more pharmaceuticals, to take a drug. If that doesn't work, take that drug. So the pharmaceuticals are making tons of money, the food industry is making money, and the banks are making tons of money. It's all tied together. And then like Tom Homan, who's head of he's the new board czar. That guy's like right out of Dukes of Hazzard. He looks like Bo Duke did in like 1980. The Dukes of Hazzard. Like there's an old
Sure.
picture of him. It's classic. It's America's Great Awakening. Then after they go through the food system and the border control, we start getting America back on a stable base. The last man standing, it's a monetary system. It's a Federal Reserve. So if it appears truly that Trump is, bringing America into this great awakening, and the last bastion of America that has been untouched is that Federal Reserve. It is our monetary system. So I believe that the Trump administration, they are going to address that and they are going to touch it. But it's only that they're only bringing gold in as that first step to restore some sort of false confidence in the dollar. And they're not fully backing the monetary system with gold. They're just reintroducing it, pegging GDP to gold in order to, try to restore some sort of faith.
Hmm. It also seems to me that part of that great awakening, what you call here, would be people waking up to the fact that the Fed doesn't have a dual mandate. It has only one mandate, and that's to keep inflation going, which I know you've also talked about.
To keep inflation what?
Going to keep inflation higher. I
Yeah,
mean, there's going to be no deflation.
it's like the Matrix. It's like the red pill. The Fed's mandate is to provide the stable, low inflation and a stable economy, and keep jobs going. But what if I were to tell you the Fed's mandate is to produce inflation because this deflationary house of cards needs more and more debt in order to keep growing? That's the only way it can keep growing. And the Fed is there to prevent that deflationary collapse. They are there to push debt higher. They are in any measure that they possibly can.
Hmm. Garrett, I want to talk about or move on to talk about what you do with this information, though, because I'm in complete agreement so far with you as to how these things are going to play out. Like Lynn out and like saying nothing stops this train, and as far as there's nothing to stop this fiscal and monetary train, gold is going to be going higher. But what are you doing with that information? How have you managed to make money off of all this knowledge? Because your portfolio, creatively named the Golden Portfolio, the GPIV is up close to 160% year to date, whereas the GDX is still lagging the underlying metal. So how come? What are you doing differently?
The GP4, the GPIV is my introductory product, but I created the Golden Portfolio because I've been doing this for nearly 20 years. I've been a mining analyst for 20 years. If you look at the average miner versus the gold price, 95% of them underperform the price of gold. Gold does better than the vast majority of miners. Why? It's because of the double D's. It's because of dilution and depletion. You need to find companies that can grow value on a per share basis, and that's very hard to do in the mining sector. That's the only thing that drives stock prices. Agnico has been doing a good job at it for decades, which is why they have been able to outperform the price of gold over the past 10, 20 years. But like I said before, you need to find high grade mines that can generate enough shareholder value, so management can buy back shares, issue dividends, pursue accretive projects. And then, after going through so many different business deals and transactions, like as a simple business owner, if you pay $100 for an asset, you hope to get $100 back every year, or $200 back every year for 10 years. And then that's a profitable investment. You put down 100, you get $1,000 back. Okay. The average miner, some of the stuff I've seen them do has been absolutely ridiculous. They paid billions of dollars for an asset. They spent another few $100 million building that project. And then you look at their free cash flow from the mine, and it doesn't even add up to the amount of money that they spent. They're not getting their money back. That's shareholder wealth destruction. And I see it over and over and over again in the industry. So I created the gold portfolio with my initial product, the gold portfolio, which is based off the royalty companies. Royalties I see are the best way by far to play gold. I went back and I made a model portfolio, and I'm like, what if you just invested in the royalties over the past 15 years? How would you have done? And you would have been up 13,000% versus the GDX being down like 10 or 20% over that time. Why? Because the royalties have fixed costs. When inflation pushes gold higher, costs rise as well. So a lot of these mines that are low grade and unprofitable right now that you see heavily promoted on Twitter, it's like, oh, wait till silver's at 50 or wait till silver's at 100. This project might be uneconomic now, but when it's at this high, it's going to make so much money. No, it's not. You know why? Because when inflation pushes silver that far higher, that project's costs are going to be so much higher. It's still going to be unprofitable at $50 silver as it is now. And then the other thing with the royalties, so they have fixed costs. They pay fixed amount of money for the stream up front. As the gold goes higher, their costs never change. Franco-Nevada, they own Cobre stream on Cobre Panama that got shut down by the Panamanian government in last year. The owner of Cobre Panama, First Quantum, went down by 75%. Franco-Nevada went down by 20% because Franco's extremely diversified. They own about 300 royalties. So all they need are one or two to get lucky versus a mining company. If one of their projects goes down, the company's basically out of business. And then the president of Panama, the new president of Panama, just stated, that they need Cobre Panama back in production. They're facing tremendous amounts of, government debt, same as we are. They need revenue in order to pay for it. They need Cobre Panama back online. It's just a matter of time before Cobre Panama comes back online, putting 190 mil, which is 20% of Franco's free cash flow, back onto their profit and loss. And then Franco pays nothing for this, whereas the operator, First Quantum, is going to have to pay hundreds of millions of dollars to restart the operation. And then another thing is royalties. They are operated by a small group of people, 3, 4, 5 people. A CEO, a guy who counts some money, and a geo. You can basically run them on. So their overhead's very low. And then there's been massive consolidation in the royalty sector over the years. You can look at Nomad. You can look at there's about 5 or 10 acquisitions. Great Bear Royalties got taken out. Any smaller royalty that has a good asset has been taken out by the majors over the past few years. And in my GP, I have 4 or 5 royalties, including one smaller guy that owns a 1% NSR on this project Anglo Gold owns. And I know this because I've seen this Anglo Gold report this in the financials. It's a massive asset. It's going to be the largest gold mine in the world when it's in production in a few years. And it's amazing. And this company, this royalty owns a 1% NSR. The majors are going to come in and take out this smaller guy at a significant premium. And I've never seen wealth generation like this across any sector. And then my second portfolio, the GP10X, are smaller explorers, developers, and some miners in there. And it's focused on high grade miners that can drive economics on a per share basis that are run by the proven value generators of the industry. Again, a lot of the mining companies I see heavily promoted on Twitter, they're not good companies. The good companies don't have to pay for exposure. Bad companies do. So I'm just saying, as a caveat, if you see, gold miners heavily promoted somewhere, like the chances are it's probably not a good investment. And then my secret skill, my super skill, I basically can go through a company website and presentation in about 15 seconds, know whether it's like a good investment or not. You know what I mean? Whether to dig deeper. And then, we spoke earlier, about the Lassonde curve and, where you try to time assets after they get financed all the way to production. And then I believe in that as well. And I try to find assets that fit that mold as also. And then, straight up, like when a mine enters production, it's got a whatever, 10-year mine of life, 15-year mine of life. It's depletion. Like you mine 100,000 ounces, your reserve is 100,000 less, right? Unless you kind of get lucky and add through exploration upside, which is relatively easy done in the mining industry. But it's they have assets that deplete. That's why most mining companies are not a good investment because it's a depleting asset. It has a terminal end value. Whereas growth companies like Google and Apple, you've got that lump sum at the end. You put a growth rate on it. That ends up being the majority of your NAV. The end run value of a gold mine is zero, So you need to find the ones that can add a significant amount of value. And the main way companies do that is through drilling. And I follow high grade drilling results very closely because one good drill hole can add hundreds of millions of dollars of market cap to these small operators. And then once the high grade drilling results start, they often continue for years because you get one drill hole where you kind of got lucky. And then they need to prove that asset out and they keep drilling, uncovering more and more ounces. And then you throw an economic study over it and you find an asset, that could produce 300,000 ounces of gold a year and it's worth $2 billion. And I found one, that trades, it's undercovered. It's not covered by any research analysts. It started up during COVID. No one knows about it. The management haven't done any marketing. It trades at like 5% of its NAV value at $2,500 an ounce of gold. It's just these opportunities are, what I started the golden portfolio for. And, I found some really good ones along the way.
A lot of things to talk about. I actually think that all companies need, especially the non-revenue generating companies, they do need to promote their product, which is their shares in that case. So the revenue driving companies, they should be figuring out a way to get into free cash flow instead of being out there promoting. So I feel you on that point. You said you can go through a presentation and website in 15 seconds. That's kind of a wild claim. So I got to ask, what are you looking for? What do you do? What's the secret?
It's people and it's drilling results and it's value creation. Three simple things, but after 20 years in the biz, I'm able to identify the good operators in the business. You guys are all located in Vancouver and Toronto. It's pretty incestuous. And I know the good operators from bad operators. There's operators that owned merchant banks where they just, where they're running five companies out of one office. Just trying to cash in on investors. Basically, they mine their investors instead of mining their assets. So those are the companies that I try to stay away from, and that's what I've picked up within the industry. And then I respect the royalties. The royalties are very interwoven amongst the industry. They have very smart geologists. So if I'm able to see that Franco or Wheaton is involved in some of these companies or involved in some of these deals or interested, they found something that they're willing to put up a few $100 million of capital in order to invest in, makes me a lot more comfortable with it, investing in this project as well. And then one other thing regarding shares. Shares is like my secret metric because it's hard to find historical shares outstanding on a publicly available website. Like Google will show you current shares outstanding and Yahoo will show you current, but it's not showing you historical. I'm lucky enough to have a Bloomberg where I'm going to see the share price chart and I change from last price. I look at shares outstanding. And when I see shares outstanding going from 50 mil to 300 mil over the past, whatever, five years,
Hmm.
I become very worried. But if I'm able to see value creation along the way, they've spent 50 mil here, 50 mil here, and they've been able to produce an asset that's worth, $1 billion, I feel better. But the majority of these companies don't add any value along the way with constant share dilution.
Yep.
One of the silver miners, core mining, people think silver, everyone's like, oh, core. Yeah, core. Core split adjusted was like $300 per share back in the late 90s. Now it's like $5 or $6 a share. It's down 97%. Why? Because their shares outstanding has gone up 100x over that time. Bankers and management get rich and shareholders get screwed. Core tries to keep production at a stable level. They got depleting assets, they add production, keep production stable. And the way they do that is by doing a lot of share deals. And then in the end, the shareholders are left holding the bag, whereas management and backers continue to get paid. So, that's primarily, what I look for. That's one of the things I stay away from.
Hmm. You're mentioning here draw results again, and then you mentioned them earlier. What is it that you're looking for? I understand you like high grade, but high grade is not everything. It's margin that you want. That's what I'm always being told. What are you looking for?
What do you mean by margin?
Margin, as in, do these rocks make money? I mean, it could be high grade, but it can be 2 kilometers down deep, and then taking it
Yeah,
out will cost you more than the value of the rock.
yeah, quite simply, on its surface, being a mining analyst is relatively simple, but when you get into it, every deposit's different. There's no deposits that are equally alike. You could find, high grade ounces, but they're 600 meters down. It's going to cost hundreds of millions of dollars in order to mine that rock. So it's probably going to be uneconomic. You have open pit mines, you have underground mines. Underground mines are generally, high grade, gold, silver, epithermal, which are really narrow veins, and it's really tough mining versus, like a copper company that has, 200 meters of, whatever, 0.6% of a copper equivalent basis. Whereas you can just kind of take a shovel of dirt and process it. It's totally different mining, the open pit versus underground. And there's many variables between the two as well. Rio too, Alex Black, Phoenix in Chile. It's a huge, largest high grade oxide pit in a gold open pit in the world. And it's extremely economic because Chile's a relatively low cost place to do business. And then it's run of mill ore. Run of mill ore means you take a shovel, you dig the dirt, you throw it on your heap bleach. That's it. There's no processing, there's no crushing, there's no nothing. It's extremely accretive. And Alex is a proven value generator in the industry, so I tend to follow guys like that. But my 20 years of knowledge allows me to kind of dig into each project in order to determine the true economics of each.
Yeah, I I agree on Alex. I just did 2 deep dive interviews with him actually over the last couple of months. Is what I've done. So I follow that story closely. You did mention royalties there. You said 4 to 5 royalties. There aren't really all that many. So what do you own?
I own the big boys, Franco, Wheaton, Triple Flag. Triple Flag's an interesting story. There's a guy, Paul Singer. He owns Elliott Management based out of New York City. He manages, I don't know, $20 billion of investors' capital. He's a traditional investor, tech stocks, value companies, bonds, traditional portfolios. But Paul Singer's a gold bug, and he's a smart dude. And he wanted to get involved, and he knew the best way to get involved with the gold sector is through the royalties. So he hired Sean Usmar, that was CFO at Barrick, and he started his own company called Triple Flag, based out of New York. So if you get a really smart dude like him, starting royalty companies, it's a pretty good, efficient business model. So that's one thing. I don't know, there's 5 or 6 smaller ones. I look for hidden value. There's one smaller royalty company. You see, a lot of these royalty companies start out as prospect generators, where they just own assets. They're far away from production. They're not able to monetize them really, except through option payments. So these companies are basically running at a loss. So they suffer a little bit of, dilution, basically time decay and options that I try to avoid. But as these assets age, and as they keep moving up the food chain and get closer and closer in production, the royalty companies are able to monetize them more. So I look for royalties that are in the sweet spot, with revenue that are able to offset their management fees, so they can run it cash flow neutral or even better, put money in the bank. And there's a few of them out there right now. There's 4 or 5 of them out there right now
Hmm.
that I like.
Yeah. Well, so as far as I understand it, you kind of built the portfolio from the perspective of you start with royalties. That's kind of the cornerstone of it all. You go into a few producing companies, and then you look for good discoveries that have high grade and are growing. Am I getting that correctly?
Yeah, it's so I got the gold portfolio, which is one portfolio. It's all the royalties. Like that is the best way to play gold. It's boring, it's long-term investing. But these royalties, they do well when gold goes up, and they do even better on a relative basis when gold goes down. You get Franco growing from $2 a share to $160 per share. The miners can't do that, or they have trouble doing that. The stories of miners doing that are few and far between. But the royalties can do that because it's accretive value. And then I have a second portfolio, like when gold is in a true bull market, like we are now, the best companies to invest in at that time are the smaller explorers and developers and, smaller miners, because when gold shoots higher, these companies go up, 5x, 10x in value, which is why I call it the GP 10x. But, you got to pick the right time in the cycle for these, because, when gold goes down, this part of the sector doesn't do very well.
Hmm. What do you have in there now?
I have 30 companies. You need to be very well diversified, because, if you are wrong in your timing and gold does go down, you need to have some companies in there that can drive value, regardless of the gold price. Like I look at the gold price as simply the cherry on top of a, strongly value generating operation. And the way they do that is through exploration, proving out reserves, building an economic study, doing incremental stuff along the way to improve recoveries. And you get companies that can generate shareholder value even when the gold price is going down. You look at Snowline, right? Snowline's done great. It's an amazing asset. They just keep returning better and better drill results that are amazing, every step of the way. They've been able to drive significant value, even though the gold price hasn't been good, like 2, 3 years ago. Now that gold's good, it's the cherry on top of a successful company.
Yeah. Yeah, exactly. So is it, what do you look for in those companies? Because do you have a checklist, or how do you go through? Because 30 is a lot of names. So how do you follow along?
Yeah. I know I've gone through so many companies, but like I said, my magic skill is being able to, go through it in 15 seconds, so I know which companies dig deeper. But based off drill results, with my experience, I'm able to estimate a ore body, right? Calculate reserves. I'm able to lay an economic study over it. And then what I do is, I find nearby comps, right? I look at the comps in Guyana and Suriname. There's currently mines operating there. I look at their, cost per ton, and then I apply them to this ore reserve that is not in production yet. And I figure out, what their feasibility study or economic study is going to look like, my estimate of it. And, I've been pretty good at it in the past. I'm pretty close to what the company comes out to. And just the value, that I see being generated in these smaller explorers and developers is crazy right now. I see, these developers trading for 5 cents on the dollar. The higher price of gold, gold's gone, whatever, $2,700 an ounce, and it's driving value in the underlying project, and the miner stock price hasn't moved at all. So that's, one of the reasons why I know the average investor is not on board yet, because of the value that I see in this sector that I am capitalizing upon. And now regarding the 30 stocks, in gold investing. We all know Eric Sprott and Rick Rule. Their portfolios, they own hundreds of things. What they do is they let their top 2 or 3 picks, their winners, they ride them. They don't sell them. The average investor doubles down on losers, losers average losers, and they sell their winners in order to raise cash to buy more losers. Sprott and Rick will do the opposite. When you get a winner, there's something intrinsically going on there that is telling you it's a good company, it's a good project, it's got to go higher. And you can see that in the share price. So you should be actually doubling down into winners, at certain points. And then, 50% of your portfolio might fall in value. You might have a few that might fall 90%. But you see, when you have a few in your portfolio that go up 2x, 3x, 5x, 10x, that more than covers all the losses in all your other stocks, and that results in your portfolio gain. So, that's why the GP10X is 30 companies,
Hmm.
because we've got some big winners already this year. Some of them, we've got a few up 200%, a few of them up 150%. There's a few others that are down, 20%. But the big winners cover more than the share of the losses. And then one thing that's interesting in the gold sector is it's so dominated by the GDX and GDXJ, right? Like all miners try to do is to reach that market cap threshold to get in the GDX or to get in the GDX. And they have so many assets under management in those ETFs that often creates a price top. When a company is added to the GDXJ, the price will spike up to often a top for the next few years. But I'm trying to find the companies that are the next candidates to become, a GDX or GDXJ component. As they move up the food chain and they're finally added, it just drives significant amounts of shareholdership in trading volume and market cap. So I see it as a, opportunity and undercovered part of the sector.
Hmm. What about physical gold, though? I'm not hearing too much about physical gold. Do you have that in the portfolio
Yeah,
somewhere?
no, I'm an equity analyst, so no. But like I said before, gold, physical gold outperforms 95% of the mining investments. People get all lit up about gold and they're like, oh, I'm going to buy a gold miner. But you got to understand, gold miners, they're stocks. Stocks are driven by, earnings per share. So they're companies versus gold, which is no one's liability. So it's a lot harder finding a good mining company that can generate, accretive profit growing potential than it is just to buy gold and kick back, but it's boring. You know what I mean? Like if you go buy gold, it's sitting back in your shelf, behind your shoulder, just sitting there and waiting. It's not exciting. But, in the mining sector, it's hard to find the winners. But when you do find the winners, you can make significant returns, but you really got to know what you're doing.
Hmm. When it comes down to selling, how do you know when to sell and what to sell? You said you've done well on some of these positions this year. When are you going to be selling some of them, or have you been selling some of them?
Yeah, the royalty portfolio, there's a lot of smaller guys. We're equally weighted across all of them. Waiting for basically acquisitions that happen regularly across the sector. That's basically a longer term hold because they run without dilution. So I'm not worried about, dilution. They represent, options with no time decay on the gold price because they have fixed costs versus the miners. The miners are much tougher to time, and the developers and the explorers. I've already had two or three acquisitions in the portfolio for the small explorers. One company, Reunion Gold in Guyana, was taken over by G Mining early in the year. Silvercrest Metals was taken over by Core Mining. Avizel Royalties was spun out of one. So there's value creation ongoing. So yeah, I totally agree with you. We spoke earlier about the song curve. You get a peak at exploration success. You get a peak at the beginning of mine production. And then it makes inherent sense to me because, a mine is a terminal asset. So the top of production, they start mining, it's depletion. They're on the back end of the slide. And I've seen it. I've seen it occur. I've seen it occur in Silvercrest. Silvercrest peaked out basically had a huge spike up right when it entered production. And then it just recently went slightly above that 3 or 4 years or 2 or 3 years later when it got bought out by Core Mining. But that often represents, the peak of, these companies. However, there are some companies that are in production that are able to add value on an ongoing basis, but these are rare birds, and they got to be world-class resource, world-class ore bodies. Lundin Gold, right? Fruta del Norte is an amazing gold mine. It's like 13 grams a ton. That company been in production for a few years, and they've been able to generate significant drive earnings per share every single quarter because of increased production and higher grades and free cash flow and buying back shares and dividends. It's an amazing value generation story. But the mines that can do that, it's probably 5% of all the mining assets out there.
Hmm. And then when it comes down to getting out of these stories, are you looking for kind of an absolute return where you're like, if we make a 50% profit, I'm out, or if it doubles, I'm taking my money off the table, some kind of a rule like that?
Yeah, no. In a gold bull market, crazy stuff happens, and I'm not seeing it yet. Like if we get to a point where it gets really wacky, I will probably evaluate that at that point. But all I'm seeing is value. There's a company, Longcore Gold. They operate in the DRC. I know the DRC is not the best place to mine, but Mark Bristow of Randgold, of Barrick now, has been operated there in Kibali successfully for 15 to 20 years. Kibali is like an amazing gold mine. It's one of the best gold mines in the world. We've never had one incident there over the past 15 years at Kibali. They've operated smoothly. And then you get a company like Longcore that owns a Dumby, that's a tier one asset. 300,000 gold ounces per year at a very low cost. You apply Kibali's metrics to it, it's worth $2 billion. That stock trades for $30 million market cap. Like the value just jumps off the table to me. And I'm not seeing the companies I invest in, they're not near the value that I see them worth based on my economic model. Silvercrest was an example also. I had my economic model on Les Chispis. I showed it was worth whatever, like $1 billion, $1.2 billion at 24, $23 silver. And back a few years ago, the stock price jumped above that value, and that ended up being the peak for the next few years. So, when my estimate of company, when the market capitalization reaches my estimate of company value, that's when I evaluate and start thinking of getting out.
Hmm. We've kind of come full circle. We started talking about a very high level economics, debt, spending, gold, silver, and everything else. What am I forgetting to ask you, though? You've been very generous with your time, but what am I forgetting to bring up that you think is important to talk about here at the end?
I don't know. I think a lot of gold investors got spooked by Trump coming in. A lot of people think that, that he's going to cut billions from the deficit, and that the deficit's going to be going down. We're going to magically have a balanced budget, but it's not going to happen. Based off all the sentiment measures that I follow, the average retail investor is not invested in the gold sector. I believe that we are close to the end days of Keynesian supply side economics, where debt is $37 trillion. Scott Bessent recognizes this fact. All of our politicians recognize this fact. You can't keep on spending. And we are at the accelerating phase of, debt spending. Like it's got to increase at an exponential rate in order to keep this economy going. So instead of it going down, I see it going up higher, quicker than before. A lot of investors aren't on the same page. And then gold, $2,700 an ounce, big deal. We're like the stuff I'm looking at, gold's not going to peak out until $5,000 an ounce. And, thinking these gold prices at $5,000 an ounce. And like I said, how I evaluate when I get in and get out, I'm long term, I build my economic model. And when the stock prices get up to the value of my economic model, I start looking at getting out, and we are so far away from that I have trouble expressing. In my research, I'm able to express it more. But this isn't going to turn in a dime, and it's continuing, and yeah, don't expect it to change.
And that's Garrett Goggin, not David Goggins, but Garrett Goggin of the Golden Portfolio. For people who want to know more, it's goldenportfolio.com, or just simply Garrett Goggin on Twitter. These things are going to be on your screen right now, so you can go and check him out. Garrett, thank you so much for your time today.
Awesome, Antonio. Thank you. Nice talking to you.